She's a leader in providing our industry with information analyzing the auto dealership buy-sell market, better known as the Kerrigan Report. In addition, her firm also provides us with the best public market data available by providing insight on the 7 publicly traded auto retail stocks known as the Kerrigan Index. Please join me in welcoming Erin Kerrigan, Managing Director of Kerrigan Advisors.
Thank you, NAMAD, for inviting me to discuss the 2020 buy-sell market. It has certainly been an incredible year. As I share with my children, this is one for the history books. First and foremost, I pray that everyone on the line today is healthy and safe as we navigate the ups and downs of this global health crisis. While I am very sorry that I am not able to present to you in person in beautiful Miami, I am hopeful that this online format still provides you with the information you need to consider in the event you're looking to grow, or for some of you who are considering exits. With that, I just want to give you a little overview of our firm. Many of you are familiar with Kerrigan Advisors, particularly the Blue Sky Report, which we publish every quarter. If you do not currently receive a copy of the report, please do not hesitate to email me at erin@kerriganadvisors.com, and I am happy to send one directly to you. Our report now goes to over 10,000 industry participants in 35 countries. And the information in the report is based off of what we see in the industry in our client work. As you can see here, our firm offers 3 distinct services to our dealer clients. We are best known for our sell-side services, where we work on the largest transactions in the industry. Now, to be clear, we do not take listings in our sell-side practice. Rather, we advise on a select number of sell-side engagements for our very valuable clients and really focus on ensuring that we're successful in meeting each client's valuation goals. In addition to our sell-side practice, we also have 2 other services: capital raising service that we do for existing dealers and dealership groups, those dealers that are looking to expand and want a capital partner to do so, or those dealers who are looking for a buyout of an existing partner. We also have a consulting practice for growing dealership groups who may need assistance as they think through their strategic plans or assistance in analyzing an acquisition. So we do not work on the buy side, but we will help dealers that are growing and looking at acquisitions. We're really a resource to those dealers as they assess valuation and due diligence. And we're happy to have confidential conversations with anyone on the line about any of these services, so please don't hesitate to reach out. With that brief commercial, let's jump into today's presentation. It's really hard to believe that our industry started 2020 in a very crowded convention center in Las Vegas, certainly not practicing social distancing. I think I saw many of you at the NAMAD cocktail, for instance, and we were enjoying our time, hugging, grabbing cocktails, and talking very close to each other. And we had lots to celebrate as we entered into 2020. After all, industry earnings through February were up 38% as compared to 2019, and we were on our way to 2015's peak level of earnings. This was pretty incredible when you think about it, because new vehicle sales actually were not at peak levels. They were pretty flat compared to 2019. But what we saw is the higher margin parts of our business model, service, parts, used, were up considerably going into the beginning of this year. Not surprisingly, of course, deal making was also in full swing at the beginning of the year, and certainly at NADA, as many dealerships were approaching all-time high valuations because earnings were up so much. And the Kerrigan Index told the exact same story. Our proprietary index of the 7 publicly traded auto dealers and retailers was up 42% between January 2019 and February 2020, with many of the composite companies hitting all-time record valuations, namely Group 1, Asbury, Lithia, and CarMax. In fact, the index was only 7% below its all-time high in February of 2020. With rising profits and valuations on the rise, most expected 2020 to be a record year of acquisition spending, particularly for the publics who entered the year with announcements of major billion-dollar transactions. Of course, that inevitability came to a very abrupt end in March. Just 30 days after we were all enjoying our time at NADA in Las Vegas, the World Health Organization announced that the coronavirus was a global pandemic, and stay-at-home orders swept through the country, including Las Vegas, which unimaginably closed the entire strip, again, 30 days after we had all been there. COVID-19 truly did shock the entire economy, especially auto retail. With showrooms shuttered, auto sales and even service and parts plummeted. Average dealership earnings declined 65% in March, and the industry reported its first monthly industry-wide average loss in April. With that, people were worried. The virus spreading across the country, Wall Street really did panic. The Kerrigan index dropped 54% between February 20th and March 18th to levels not seen since 2012. Investors were deeply worried about the dramatic contraction in auto sales and the economy's ability to recover quickly. With the public stock prices so significantly down, their valuation multiples, of course, also followed suit. At the end of the first quarter, the public's average blue sky multiples had declined to just 2.8 times, making most attractive acquisitions dilutive to earnings and resulting in a major reduction in their spending expectations. Keep in mind that the average private dealership value is about 4.5 times. So when they're at 2.8 times on average, these public companies, they really cannot do acquisitions. In fact, instead of completing $1 billion worth of transactions in the first quarter, the public spent only $135 million, an 87% decline from their projected spending levels that we all had thought they would do. By the end of the first quarter, Kerrigan advisors found that the buy-sell market had gone into a complete standstill. Both private and public transactions were either postponed, renegotiated, or in the very worst case, terminated. The most prominent termination, of course, was Asbury's acquisition of Park Place dealerships. When Asbury's stock dropped to the purchase price of the entire Park Place deal, it made that acquisition nearly impossible to justify. You can see that Asbury dropped to about $1 billion market cap, and that's about what the Park Place deal was valued at. So that was a difficult deal at that point to justify. By the end of the first quarter, total industry transactions had declined 9.3%, with expectations that the second quarter could be much, much worse. Many were worried. But as challenging as the auto retail market was at the end of the first quarter, there were many buyers and investors who remained optimistic about the industry's resilience in the face of a crisis, particularly when they looked back on how we did in prior crises. It is important to remember that in the depths of the Great Recession, auto retailers remained profitable despite a 50% decline in new vehicle sales. Most critically, auto sales led the U.S. economy out of the Great Recession, outperforming total retail sales by 35% during the 5-year period after the credit crisis, as you can see on this graph. And dealership earnings rose an impressive 30% compounded annual growth rate from 2008 to 2012. That's 12.6 times faster than GDP growth during that same period. In fact, the average dealer returned to pre-recession earnings by just 2009. And really, this is a testament to the incredible strength of our business model. It is flexible. It can shift quite dramatically quickly to higher margin business segments. We have a high variable cost structure, so we can cut our costs quickly to return to profitability. And by the way, it looks like we're doing that all again. And that is incredible news. Maybe not surprising to those of us that are students of the industry. As difficult as March and April of 2020 were for new vehicle sales, auto dealership earnings have once again rebounded quickly from a crisis. And Wall Street, as you can see them clapping, has taken note. Since bottoming in March, on March 18th, the Kerrigan index, and this is incredible, has risen 129% to all-time highs, outperforming the S&P 500 by leaps and bounds. And while the economic impact on dealers of this pandemic, which has induced this recession, will certainly be different than the 08-09 credit crisis induced recession, for the most part, these differences have been to the benefit of our industry, and I'll walk through some of the main reasons. For instance, unlike the adversarial relationship between OEMs and dealers in the 08-09 recession, when COVID-19 hit, OEMs, as well as many other industry participants, the vendors, the lenders, provided dealers with tremendous support to ensure they could weather the financial impact of lost sales and shutdowns. Roger Penske noted this in his most recent earnings call, saying that these OEMs have been tremendously supportive of all of the dealers, and this is a very big distinction from the adversarial, difficult relationship we had in the 08-09 crisis. In addition, the Federal Reserve and the federal government moved at a much faster pace than they did in the last recession to ensure that the credit markets continued to function and businesses could stay afloat. This may be the most important difference between the last recession and this recession, and the reason that we saw such a quick rebound in auto sales in May and June. We know we are a very interest rate sensitive industry, and when interest rates are low and the Fed is supporting our industry, rebound in sales happen quickly. Within the first few weeks after realizing the U.S. would undergo massive economic shutdowns, the Fed embarked upon a program that was a quote unquote, whatever it takes liquidity to all facets of the U.S. financial system, increasing the size of its balance sheet in just days by $1.5 trillion. Congress also moved at a record pace, something most thought pretty impossible, passing the CARES Act, which included, of course, the instrumental PPP funds to ensure consumers and businesses had an economic cushion to weather the crisis. The combined effect of the actions taken by the Fed and the federal government infused an historic level of support, trillions of dollars into the economy in the shortest period ever in history. And this is the primary reason we have seen very few distressed dealership sales, even though we were in such a volatile time in terms of auto sales. Even with these dramatic declines in March and April, we really report very few distressed deals, and dealers have, for the most part, been weathering the storm. Of course, the Fed also dropped interest rates by 100 basis points on March 15th, and auto sales, as I mentioned, being the most credit sensitive of probably any retail market, are directly impacted by interest rates. So when interest rates decline, we typically see an inverse relationship with auto sales, and that's what you see historically, and that's what we're seeing today. In this low interest rate environment, we expect this will continue to prop up and allow vehicle sales to grow in the coming months. Now, lower interest rates also results in lower cost of capital. As auto retail sales have rebounded, Kerrigan Advisors also expects we could actually see blue sky values rise above pre-COVID levels. After all, the lower a buyer's cost of capital, the higher the blue sky multiple that they can typically pay, because their return expectations are lower. And you can see on this graph that when your return expectations decline, the multiple you're willing to pay goes up. And that is something that we have definitely seen in the past and could see again. You can see that's what happened last year. As interest rates declined throughout the year in 2019, average blue sky values rose. We expect we could experience the same scenario as banks once again begin lending to our industry, particularly given how well our earnings have rebounded. Banks feel more emboldened to lend to our industry and lend against blue sky. And now that rates are even lower, you could see a dynamic where valuations actually rise because of this cost of capital dynamic and the low interest rate environment in which we currently find ourselves. This brings us to an important trend that we think is probably going to shape the buy-sell market of 2020 more than anything, and that is a surge in buyer and investor demand for auto dealerships. Much to the surprise of many, certainly people that are outside the industry, as the shutdown got going, our firm actually saw a rise in buyers and new investors contacting us saying, now is the time we want to get into auto retail. And this is pretty interesting because it's coming off of a 2019 when we received a record number of outside investor calls to our firm. Of course, some of these buyers that contacted us were looking for deals. They were hoping for those distressed transactions that never came about. But for the most part, actually, these investors and existing strategic buyers, existing dealers, realize that now is a much more interesting time to invest because many were fearful and sitting on the sidelines a bit when we were in our 6th and 7th year of a 17 million SAR. They were concerned that a recession was coming and they didn't want to invest at the top. But now that we had this abrupt correction in auto sales due to COVID-19, these buyers and investors now see a tremendous growth opportunity ahead, not only because they expect car sales to grow, again in this low interest rate environment, and earnings as well, but they also see an industry that has right-sized its expense structure and is turning to more efficiencies as it relates to digital retailing and digitalizing so much of our processes that they expect earnings growth could be even more tremendous coming out of this recession. And that is why we continue to see more and more buyer demand in the industry, and one of the reasons we expect to see a continued rebound in buy-sell activity. These outside investors, by the way, and large dealership groups also tend to have outsized access to low-cost financing for acquisitions. And with this lower cost of capital, these companies are better positioned to meet sellers' pricing expectations and complete large transformative acquisitions, as many of them have been doing for the last 5 years. You can see on this graph that if we look at the top dealership groups in our industry, so the top 150 that have used outside capital or capital partners to grow, those groups have grown at a disproportionate rate to the rest of the industry. They've increased their dealership headcount by 125% since 2014. These growing groups also expect the buy-sell market of 2020 and 2021 to be the market in which they really can double down. And so we expect to see many of them very successfully navigate this crisis because they have a high level of cash, they have a capital partner to grow, and we expect they will be disproportionate in terms of the number of deals they do in the next 12 to 18 months. They see lots of opportunity, especially with the cost savings from reducing headcount and really improving the efficiencies of the business model. Notably, in the first quarter, despite COVID-19, the number of multi-dealership transactions hit a record level, with 15 completed in the quarter, representing about 31% of deals, and we think an indication of the demand for larger transactions. And as we assess the data coming in for the second quarter, and we will be having our second quarter Blue Sky report published at around the end of August, early September, around Labor Day, we believe you're going to see, surprising to many, actually a significant increase in buy-sell activity in the second quarter, even despite all that we've gone through in that quarter. And our expectation is the second half of 2020 could be a record-breaking half of the year for buy-sell activity, as we see so much buyer demand in the marketplace. And this is particularly the case for the publics. You can see here that with their stock price rebounding so significantly, so has their Blue Sky multiple, making more deals accretive to earnings. In just the last 30 days, Asbury successfully renegotiated that Park Place transaction. It's a little different, but nonetheless, they are going forward with the lion's share of the deal. They removed the real estate, and that's a very transformative transaction for that company. And Lithia just announced the purchase of the John Eagle dealership group. That's adding $500 million of revenue. So it's not surprising with these companies hitting now in this case, Lithia's case, record stock price, that these companies are once again active in the marketplace and really capitalizing on their high valuations to do transformative acquisitions. With this in mind, it is our belief, as I said, that we will see a very, very active second half going into 2021. Now, this, of course, also is because we're seeing more sellers coming to market. What we are seeing is that sellers are pleased to see that their valuations are strong, that buyers are not necessarily looking at what happened in 2020, and with the concern to some degree that there may be an increase in taxes in the 2021 year because of potentially a change in administration, or more specifically at the state level, because the states need more capital to fund the challenges associated with COVID. We are seeing sellers moving forward their decision to sell and trying to get deals done in 2020 before the 2021 year. We think that is also going to result in many more transactions in the second half of the year. Now, one of the reasons, of course, we're seeing so much activity, as I mentioned, valuations are strong, and that's particularly as it relates to real estate. And some are concerned that their real estate values could decline in the future due to the rising retail vacancies with digitalization and what's happened with COVID. There are more bankruptcies in the retail industry than we've ever heard of. And for many dealers, the most valuable asset that they own is their real estate. So the value of that asset is so key to any sale. And if we look in the first quarter, we actually saw commercial real estate values decline for the first time in 10 years due to the economic shutdown. Now, this decline could be temporary given the recent reduction in interest rates that I talked about, which often have the effect of increasing asset values. But there may be more dynamics at play today in the commercial real estate market because of the number of empty properties. In particular, these properties, these retailers closing, and restaurants and entertainment venues closing, that could result in a sharp decline in property and land values, which may lead to further declines in property values. And again, since this is such a valuable asset to most dealers, it is very important to track that. And I think one of the reasons dealers are saying, I want to capitalize on the values that we have today in case they go down. It should be noted that retail store closures actually spiked sharply before COVID due to consumer shifting preference to digital retailing. In fact, in 2019, we saw a 34% rise in store closures, and that was before we even had this economic shutdown. So this is a trend that got accelerated with COVID. Now, while dealership real estate prices have almost doubled since 2009, they started to decline slightly last year, and this may be due to these vacancies that we mentioned. And while the decline in dealership real estate values is potentially, of course, a negative for sellers, we do want to point out that moderating the ever-increasing dealership rent factor is critical to the industry's financial health and future success, particularly as we shift to a more digital experience. Prior to the pandemic, OEM facility demands were becoming less and less economic in an era of compressed new vehicle gross profits. Why were dealers being asked to spend more and more on these showrooms when in fact less and less of their income was coming from front-end gross profit? With recent increases in digital sales caused by COVID-19, we're finding that OEMs are in some cases postponing their image program deadlines and refocusing dealers' capital towards vehicle sales and investments in digital retailing rather than bricks and mortar. They really just want their dealers to move the metal and not be focused on stopping sales while they're trying to reconstruct the front end of the house. This is particularly important as rent per new vehicle sold skyrocketed to an unprecedented level in March and April. Not surprising because unit sales were so low, but it really highlighted the risk associated with the high fixed expense structure that is imposed on many dealers. Now, one interesting observation is that the differing levels of rent based on type of franchise. As you can see, rent and rent to gross profit is higher for most import and luxury franchises due to the level of finish required of these facilities. For this reason, The weaker import and luxury franchises command much lower blue sky multiples because their low sales per franchise really does not support the high rent and real estate expense that they command, and thus diminishes their blue sky value. By contrast, domestic franchises benefit from low average rent and less expensive facility requirements, which is one of the reasons we believe buyer demand for domestic franchises has increased so significantly. In reviewing the data for the first quarter, domestics continued to dominate the buy-sell market, representing 57% of buy-sells, up a remarkable 84% over the last 5 years. Now, we believe this uptick in domestic transactions has both a specific buyer and seller component. Buyers are attracted to the return on investment, the ROI, of domestic franchises, given their lower blue sky multiples, less expensive real estate, and highly profitable truck sales. While many domestic sellers are reaching the end of a multi-generational succession plan, and many have decided that today's higher valuations are really proving to be the sign that today is the time to sell. Again, many dealers that own these domestic franchises have owned them for many decades and are now realizing that, goodness, if we can get these valuations we're getting now is the right time to sell. Also, the recent push to digitalization is only, in our experience, accelerating that trend to enter the market to sell in 2020. Now, we also noted in looking at the first quarter that import luxury buy-sell market share increased a bit to 18%. Now, here we see buyers are paying more for luxury franchises, especially top luxury franchises, but they like the high UIO count and high fixed absorption of these franchises, and especially in the low interest rate environment we're in today, are willing to pay up for the higher multiples and get these solid franchises that they think will well weather any storm if we do have a longer recession. In terms of the specific franchises that traded in the first quarter, you can see that GM is not only the top minority-owned franchise, but they're also the top traded franchises. Here you see Chevrolet represented nearly 20% of the buy-sell market in the first quarter, followed by Chrysler, Dodge, Jeep, and Ram. Now, we find buyer demand for these franchises, particularly Chevrolet and Chrysler, the Chrysler franchises, is higher than for Ford at the current moment. Ford only got about a quarter of the buy-sell market share that Chevrolet did in the first quarter. And we're seeing, as you see when I talk about the blue sky multiples, a little bit less demand for Ford, in part because there seems to be more challenges with that franchise, certainly a lot of management turnover at that company. Of note, Lexus was the 7th most traded franchise in the buy-sell market in the first quarter, representing 5% of the market. That's pretty incredible given how few Lexus franchises there are in the marketplace. In the last 18 months, Kerrigan Advisors has represented on the sale of 5 Lexus dealerships, and we observed that long-standing Lexus dealers, many of whom got these franchises as open points back in the early 90s, are now deciding to sell those franchises, considering their very strong value in the market and the high demand for those franchises. And frankly, some of those folks really are looking to retire as well. This brings me to perhaps the most important part of the presentation today, and that, of course, is a discussion of blue sky multiples and values. I know that that's what most of you on the line are most interested in. Now, I've already alluded to the fact that valuations have been strong, and we have not seen a COVID discount from the challenges of the pandemic. We really are not seeing that in the marketplace. But many are curious, and they want to know, well, how are dealerships being valued given that we closed down in April and much of March? Well, what we're seeing is that today's buyers are not even really looking at the 2020 earnings when coming to their valuations. Rather, they are analyzing pre-COVID profits, usually focused most on 2019. With the industry's earnings rebounding so quickly in May, June, and July, buyers feel confident that the dealerships that they are acquiring will return to these pre-COVID earnings levels. And they believe profit growth will be achievable as new vehicle sales start to rebound and they see growth in new vehicle sales, especially given the low interest rates we find ourselves in. Now, mind you, we do have high unemployment, and I agree that unemployment may remain high for some time, but if you look back at the recession, coming out of the last recession, even when unemployment was still quite high in 2010, earnings had rebounded considerably and continued to grow, even though, as you recall, unemployment took a while to come down after the Great Recession. So for the most part, blue sky multiples are being applied to pre-COVID earnings in 2020. Now, we expect as you look at 2021, as we enter next year, certainly buyers will look at the performance, some of the performance of 2020, particularly the second half of this year. So we do think the second half of this year is very important for future valuation expectations. But until we have more months behind us, most buyers are looking at 2019 and then checking in to see how performance is rebounding as we go into the second half of the year. With that understanding, we are looking at different factors that are driving valuation in the second half of 2020 as it comes to buy-sell activity. And many of you are familiar with the trends, with these factors that we track every quarter, these 7 factors. We see 3 factors really driving the valuation right now. And of course, the other factors matter, but these 3 are the most important, and that is earnings growth expectations. So dealers that are looking to grow, especially existing dealers, are willing to pay a higher multiple for underperforming stores, whether that is a chance to cut expenses quickly. Maybe a dealership didn't really right size during this COVID period, and there's an opportunity to really cut expenses and grow that bottom line. Those deals can trade at a higher multiple. Also, dealerships that are not sales effective, we find typically trade at higher multiples than dealerships that are fully sales effective. If a dealership is fully sales effective, there's really not growth opportunity in sales, then we often do see a lower multiple for those franchises. The next is buyer demand. And this is simply really markets that are in high demand, like the Southeast. I mean, the demand for the Southeast seems to be insatiable. Every buyer I almost speak to is interested in growing in that market. And so Southeast dealerships tend to trade at a higher multiple, particularly Florida. Florida is the top market for every dealer. We've done 4 transactions in the last 12 months in that market, and we see more and more activity in the Florida market. Also Texas and the mountain states. Colorado, for instance, in high demand, as is Texas, obviously demonstrated by the Park Place dealership transaction and the most recent John Eagle transaction that was just announced. And then the third most important factor that we're finding today is revenue mix. So in this recession, we, for the first time, saw service and parts revenue decline. We didn't see that in the 08-09 recession. But what we're also seeing is that come back quickly. And what we see is that buyers really do prefer franchises with strong fixed operations, high UIO count, high fixed absorption. And those franchises tend to trade at higher multiples than franchises that do not have a strong base of UIO count and strong service absorption. Now, one note on real estate. Real estate, of course, is a big factor in determining multiples. I just talked about how important it is to dealership valuation. One good point, one highlight for this year is that because OEMs are less focused right now on having these remodels done quickly, we do think that's going to be a positive for stores that do not have image compliant facilities and will potentially improve their multiple. Whereas typically that becomes quite a negative because a buyer is going to have to chart in when they're going to have to remodel a facility shortly after paying a lot of blue sky. Now they can push that date down the road a bit, and so we think that will be a positive for the buy-sell market and certainly for dealers that aren't image compliant. Now, turning to the specific multiples, these are the multiples we published in our first quarter report. You will notice, again, the stability in valuation. I'd like to point out that you saw the volatility in the multiples of the publics. Public companies are marked to market every business day, and so they can change quite dramatically in multiple quickly. In the private sector, we don't see that. We see much more stable blue sky multiples, and you can see we didn't see any dramatic decline in multiples, even with the challenges of the first quarter. That was not our experience. In fact, we even upgraded a multiple in the first quarter. We increased Toyota's multiple. This is really a reflection of the flight to quality we are seeing with buyers. Buyers that are getting more aggressive right now are certainly looking towards the highest quality franchise, and Toyota being, in our view, one of the top quality franchises, especially in the non-luxury space. You know that Toyota has the highest credit rating of all OEMs and is expected to continue to weather this storm and really thrive coming out of the COVID shutdown. We also did do some downgrades, though. You see that Ford, we downgraded slightly from the top multiple from 3.75 to 3.5. And this reduction, as I've already mentioned, is a result of some of the financial challenges Ford has had. Their credit rating was downgraded closer to a junk rating. That means it's going to be harder for Ford as a company to support its dealers with a lower cost of capital because their cost of capital is rising. That means raising capital is more expensive. They also reported a $2 billion loss in the first quarter and have had a lot of management turnover. It is our hope that Farley is going to take this company to the Malali age and really improve this company, because Ford is certainly an incredible brand, and we expect it will rebound, maybe with new management. The next is we did downgrade Buick GMC on the high and low end, and this is really because sales per franchise is so low for this franchise. And as sales, the SAR is down, is probably going to stay down for a little bit here, though these franchises really do struggle with profitability in times like this. So we do expect to see the multiples of this franchise at a lower level in 2020. And finally, Nissan. Nissan continues to certainly have its challenges, and we did downgrade the multiples for Nissan as they continue to have management turnover and certainly significant losses and sales declines. I will say, however, that there are a lot of Nissan dealerships for sale, and there are contrarian investors out there that are buying them up, knowing that this is a very big car company that they do believe will weather the storm, and you can make a lot of money with these franchises and have a very high return on investment given how little it costs to buy them right now. So the valuations are down, but we may see a tremendous number trade hands in 2020. Here you'll see all of the analysis that we do, some of the analysis that we present in our Blue Sky report for each franchise. And again, I'll just point out the credit ratings. There's a high correlation between the strength of a franchise and the OEM's credit rating. And this is not surprising because so much of our industry, as I mentioned, we are the most credit sensitive retail industry in the country. And so when the OEM has a strong credit rating, that means they usually can have a very supportive captive. That captive not only supports the consumer buying the vehicle, but also supports the dealer buying a dealership and can finance more of the acquisition. So that certainly helps to prop up Blue Sky values for those franchises with strong credit ratings. Here I turn to the luxury franchises, and you can see we didn't make any changes last quarter, and we don't expect to make much change this quarter either. There really is a have and have not scenario with luxury franchises. The franchises on the left are in high demand and tend to have very consistent profitability. They have high UIO count and just very attractive to buyers. Whereas the franchises on the right, unfortunately, their just sales per franchise is so low and their cost of operating is still high. They have expensive facilities. And so while there are certain dealers that make great money in certain markets with these franchises, for the most part, they tend to trade at much lower valuations. Now you're going to note that we added Lincoln to our franchise review. This was in the end of 2019 we added Lincoln, and Lincoln has had tremendous growth from a small number, but that is something we're tracking. Unfortunately, the multiple is still quite low because they still have expensive facilities, but we are noting that Lincoln has broken out with growth and really great looking new product lines. Here again, you'll see that in terms of credit rating, the Germans and the Japanese car companies, the top Japanese car companies, Toyota namely, does have the highest rating and, of course, often has the highest blue sky multiple. So there is a direct correlation there in this case as well. We will note that we do have a negative outlook on Land Rover, Jaguar, and that's because they actually have a lower credit rating as a company, and there is more competition right now going after that target of the Land Rover franchise, and there's tremendous gross profits in the SUV, high-end luxury SUV market. There are so many new high-end SUVs coming out, and there is some risk to that market share, although we do find that many Land Rover franchises, Jaguar Land Rover franchises, do make a tremendous amount of money still. So we haven't changed the multiple, but we are watching it going into the second half of the year. Just to wrap up, in terms of talking about multiples, what we're finding is there's really a situation where certain franchises have stronger pricing power than other franchises. So it's not to say that you won't see franchises trade hands that have lower multiples, but the pricing power, the ability of the franchises in the bottom left-hand quadrant of this graph that shows blue sky multiple relative to sales per franchise, you can see that bottom quadrant that has lower sales for franchises and lower multiples, they just don't tend to have the kind of pricing power that the top franchises have. And what that means is that the top franchises can push the buyer harder to get to a higher multiple than those in this bottom left quadrant. But we are seeing buyers interested in all the franchises today, even those certainly in the bottom left-hand quadrant. It's just the pricing power is not quite as strong as those in the blue circle at the top of this graph. Well, with that, I want to close up this presentation. Thank you for joining me online today. I wish it had been in person in beautiful Miami. And thank you, NAMAD, for hosting me. I hope you found the information that I presented helpful to your business, whether you're planning for growth strategy or maybe considering an exit. And I look forward to having a confidential conversation with you if you would like to speak about any of our services and what we can do to help you as a dealer. There is no doubt in my mind that this pandemic is one for the history books. And while we do not know for sure if we will be celebrating in person or via Zoom, I hope in person, at NADA 2021 in New Orleans, where our firm will be doing a workshop, hopefully in person, we are very confident that by the time we get to the January timeframe, the dealerships will have much to celebrate in 2021 as you not only survived 2020, but you thrived during this challenging time. With that, thank you very much. Please stay safe, stay healthy, and I hope to see you very soon. Thank you.